Canada's housing market is shifting faster than most people realize, and the headlines you see barely scratch the surface. Interestingly, affordability has improved, with prices sliding and rates coming down, but confidence has collapsed. Jobs are disappearing, construction vacancies just fell by over 14% in a single month, and there are more Canadians receiving employment insurance than there are job openings. At the same time, Canada's banking regulator is tightening the screws on investors. New rules will make it much harder to use rental income to expand portfolios, while institutional landlords get an open runway. And if that wasn't enough, the presale market has cratered, with Toronto recording its weakest August in history, and Vancouver not that far behind. In this video, we're breaking down the numbers, the regulatory changes, and the government's next moves, or lack thereof. You'll see why the gap between presale and resale prices is flipping for the first time in decades, how housing starts are collapsing, and why institutional investors may be the biggest winners in this reset. We're starting today with a touch on affordability and the aforementioned jobs market. Home prices are obviously coming down in the major metros like Vancouver and Toronto. And the overnight rate is now down to 2.5%. Affordability is technically improving, though off of very painful highs. Affordability levels are now back to Q4 2021 levels. This is essentially taking home prices versus income versus interest rates. When we look to that era of Q4 2021, home sales were 46% higher than the most recent quarter. So interestingly, when homes had the equal amount of quote unquote affordability, home sales were absolutely flying in 2021. But understandably, that was a very different market, right? Prices were ripping and people were diving into the market because it just looked like prices would continue to go up in the future. So today is a very different landscape. And it tells us that confidence in the market is having way more impact than affordability. Sentiment today is that unemployment levels look to continue to rise and home prices look to continue to lower. This is simply not an environment where too many people jump in and make $1 million decision. When we look now to the jobs market, the amount of jobs available took a steep 4.2% month over month decline last month, equating to 21,000 less jobs available in the country. The vacancy rate lowered to 2.6%, the lowest print dating back to 2017. We're at an 8-year low. The drop was most notable in the construction industry, where vacancies collapsed a whopping 14.3% month over month. We've been reporting on this for some time, and now the numbers are truly coming to light. When a construction worker completes a job, they're finding it very difficult to find the next project available for them to go to. The number of Canadians receiving employment insurance today, well, get this, it's up 13.8% nationally over just the past 6 months and up a whopping 23% in Quebec. Today, there are just over 550,000 Canadians receiving employment insurance. And by comparison, there are just 460,000 job vacancies available.
Man, if that's not a state of the union, I'm not quite sure what is. But it's unfortunately going to get tougher to build wealth in Canada, especially in the real estate sector, as OSFI has come out with some new regulatory changes. Canada's banking regulator, OSFI, just dropped a big update that's going to matter for anyone holding multiple properties relying on rental income to qualify for those mortgages. Starting in 2026, new rules will change how banks classify income-producing residential real estate. The key takeaway is this: income that's used to qualify for one mortgage can't simply be recycled again to use and qualify for another. If you've leveraged a rental income on one property to get financing, that same income won't count towards buying your next one, even if you have a surplus. Why does this matter? Because once a mortgage is classified as income producing, banks have to hold more capital against it. And that often translates into stricter lending terms or higher rates for investors. OSFI's goal here is consistency across all lenders, and they're giving banks the flexibility to use their own internal system as long as they're at least as conservative. For borrowers, especially investors with multiple doors, this is a direct tightening of how both the rental and employment income can be applied across your portfolio. It's a clear signal that OSFI wants to limit the risk in the housing sector by making it harder to keep stacking properties on the back of the same income streams. But this isn't the only change tucked into OSFI's new guidelines. They also confirmed that with combined loan products, things like mortgage bundles with lines of credits, if you default on one, the whole package will count as defaulted. That could have big implications for borrowers who rely on HELOCs, and banks themselves are being held to new capital floors, with OSFI maintaining a sector-wide minimum at 67.5% until otherwise notified. Looking further ahead, OSFI signaled what's coming next: a complete overhaul of the mortgage and credit risks rules, including B20. That draft will land in early 2026 and will merge residential, commercial, and corporate lending guidelines into one unified framework. So what's the bottom line? Well, for property investors, the days of recycling rental income across multiple mortgages are coming to an end. For lenders, capital requirements are tightening. And for the broader market, this is yet another sign that regulators are laser focused on reducing systemic risk in the housing market. I do have a couple thoughts on how this could play out in terms of how it's going to affect the middle class, because that has been shrinking like crazy in Canada. And it seems to be a further exacerbation of those who have wealth and those who don't. For example, pension funds, real estate investment trusts, REITs, and private equity can now finance acquisitions with corporate debt, bond issuance, equity capital, all effectively sidestepping the mortgage rules entirely. They can tolerate capital buffers that small investors can't. As financing options shrink for individuals, distressed or growth-constrained landlords will be more inclined to sell these properties. Institutions with dry powder will be positioned to buy these assets in bulk. This mirrors patterns we saw in the post-2008 US economy, where hedge funds and REITs scooped up foreclosed homes en masse, converting them into rental portfolios. With affordability already strained, renters will increasingly live in properties owned by professional landlords, no longer your mom and pops, investors. So my feeling on this, OSFI 2026 rules will make it much harder for the middle class to use leverage to build rental estate wealth. Institutions with their deep capital pools and corporate financing structures stand to benefit. The shift completely accelerates the professionalization of Canada's rental housing market and will likely reduce home ownership as a pathway to middle class stability.
Yeah, so of course I have a few comments on this as well, or a few thoughts. First one is, let's take the other side. Let's play devil's advocate. And this might potentially protect people from themselves from becoming over leveraged, right? It's almost like a stress test on future investment properties. And when we look, back, hindsight's 2020, the stress test today looks like a genius idea. It definitely saved some people from losing their home, realistically. So is this kind of in the same light where they're just trying to say, look, people have been over leveraging themselves too much. This will prevent that down the road. Perhaps it's a good thing there. Like a lot of these rules that come into place, it does ask more questions than answers, and it doesn't necessarily seem like it's fully thought out. For example, if somebody bought a presale, let's say last year, and it closes in 27 or even after, early 2026, are they suddenly in trouble or at risk of not being able to close because they were looking to leverage their other investment properties to be able to purchase this? Does this grandfather in those contracts? I could not find any documentation about that. So that'll be interesting. And if I want to throw on the tinfoil hat and say, okay, why might they be doing this behind closed doors? Or what is that decision? Like Ryan obviously discussed here, the institutional investors are the ones who will benefit in the sense that, there'll be fewer and fewer mom and pop investors that want to create that and build their portfolio. And this is happening at a time when there is a record amount of purpose-built rentals under construction. So are they looking ahead and saying, look, we are seeing immigration down, we're seeing population growth down, and we're seeing an absolute onslaught, if you will, of rental units coming to market. So the writing's on the wall as to what's going to happen with rental rates there. So how do we protect them? How do we protect the people with the big money that are bringing all these units to market? Well, let's try to close out the other people that would be essentially competing in that same landscape. Again, tinfoil hat thought, but it did come to mind. I think lastly too, something that it doesn't touch on is there is nothing stopping an investor today from going out and purchasing 5, 10 pre-sale condos, for example. And if they don't close for, let's say, 4 or 5 years or more, you can't qualify for that mortgage today, right? The longest secure pre-approval you can get is like 3 years from BMO and I think 4 years from RBC. But again, there's no stopgaps, or there's no gating there that's prevents somebody from potentially getting into a bunch of trouble. If they don't know about these rules and they're not advised, they simply walk in and say, yeah, I want 2, 3 of these, whatever the case may be. They're suddenly exposed when, 4 years down the road, they find out, oh, wait, what? This exists? I can't leverage the income on these to close. Anyway, a couple thoughts. I'm sure you have some too. We'd love to hear about those below. Okay. Want to touch on a very polarizing topic that has really gotten a ton of comments. It's regarding government intervention in the housing market, right? The housing market is in trouble. A lot of developers are asking for help from the government, and a lot of people think they shouldn't be, and they don't deserve to be. So I'm not taking a side here, but I'm going to share some more intel. So there's obviously no question the presale market is struggling at an extreme rate. For example, the latest numbers out of the GTA are nothing short of alarming, right? And the implications, well, they reach way beyond just Toronto. According to Altus Group, the month of August saw just 300 new homes in the GTA sell. That's down 42% from the same month last year and a staggering 81% below that 10-year average. To put it into perspective, a normal August would see about 1,600 sales. This year, 300. And it's not just Toronto. Other Ontario markets like Ottawa, Kitchener-Waterloo, they're struggling, and Greater Vancouver is down to a third of its usual activity. And even Calgary, which has been one of the strongest housing markets in the country, is starting to show some troubling signs as well. Now, here's why this matters. On the supply side, new project launches, especially condos, have slowed to record lows, while at the same time, completions are at record highs. That means builders are finishing up homes, but definitely not starting new ones. As more and more projects wrap up, tradespeople, construction industry are facing those layoffs I talked about and adding to the growing number of Canadians that are out of work. So it makes it not just a housing story, but an economic one. When we look at the data here, condominium sales in the GTA dropped nearly 60% year over year, and they're 90% below that 10-year average. Single family sales are down to 21% year over year and 59% below the long-term norms. County, which is a newly tracked in the data, just saw 36 single-family sales in August and not one single condo transaction. Inventory is obviously building up too. Across the GTA, there are over 22,000 units of new home inventory sitting unsold. That is the highest on record. And it translates to about 20 months of supply, which is double, even triple what a healthy market would normally carry. Here's the kicker. The federal government's target to build their 500,000 homes per year, right? That's, let's just say it's at risk. At the current rate, industry leaders are warning that we'd be lucky to keep housing starts in that 200,000 range. And that's not even half the goal. The Building Industry and Land Development Association, known as BILD, B-I-L-D, is sounding the alarm, right? Here's where we go. They're calling on the government at every level to step in with immediate relief, suspending GST on new homes under 1 million, cutting the fees and charges, the municipal charges that pile onto projects, and accelerating reforms to all these development costs. Without intervention, they say, both construction workers and families hoping to buy a home in the late 2020s are going to be the ones who ultimately pay the price. For buyers, the benchmark price for a new condo in the GTA is flattened to about $1,029,000. Single family homes are averaging $1.46 million, down 8.5% year over year. But the bigger story isn't just about pricing, okay? It's the pipeline of future supply that is very rapidly drying up. If nothing changes, we're setting ourselves up for an even more painful shortage just a few years down the line. Due to the layoffs and a drought in future housing supply, essential construction workers and hardworking families looking to find a home from the era of about 2027 to 2031 will be the ones that bear the brunt of any government inaction. We can reasonably project that there will be years of of about sub 5,000 completions by the year 2030, which you can extrapolate that out. Even that type of number, it would be well below even pessimistic demand levels for that time. So the question becomes, Will governments move quickly to support the industry that keeps housing starts alive? Or will they wait until the slowdown cascades into basically a full blown housing downturn beyond what we're seeing today? So again, bailouts happen all the time across many different industries. Does the housing industry, do construction workers deserve a bailout? Or should the government just stand back and just let the market reset? Love to hear your thoughts on it.
This is a result of some really, really bad decisions that took place 4 or 5 years ago. And we're paying for those decisions now. And I think the government of Canada, I mean, Dan, we can't even get a budget out of the federal government. Whether or not we're going to get a bailout, I mean, I don't know, but I just, all of this feels like there's a lot of signals written on the wall here. And to touch a little bit more on that, let's get into these housing starts that seem so depressing. The housing starts posted their steepest decline in a year, falling 16.3% month over month to hit 246,000 on an annualized basis. 102,000 of these are rental unit starts as well. Not far behind, all single-family home and condos combined. The number of starts will continue to fall dramatically over the next year as well, which goes back to your point earlier, Dan. How are we going to reach these 500,000 homes that Mr. Carney would like to put into the economy, especially at this absurd rental number? I just don't know how Canadians will build wealth when they've now also just been locked out of trying to do investments. So let's comment a little bit about the condos here. There was a lot of hate towards condos right now, and especially in the YouTube comments, they're full of people saying that nobody wants these. To be clear, I think condos actually make a lot of sense when they're built to meet the specific needs of those people who are buying them. Mind you, I don't think 400 square foot condos built for speculation make any sense. And somehow the municipal governments that allowed for this to happen are now penalizing the marketplace for those decisions. It's very strange. Those metrics now. So when we look specifically at the demand for single-family homes, building permits in BC as an example, these metrics have dropped to their lowest in history. That's going back 45 years. Permits just hit 4,000 in 2025. To give you perspective, in the 1980 peak, we had 24,000. Understandably, price points will be a major factor in this, but it still demonstrates how little demand there is for newly built single-family homes.
Yeah, something that I want to share as well when in talking about, nobody wants condos type of thing. Year-to-date sales in Greater Vancouver, condos are still outselling all other property types combined by a 7% magnitude. So that's detached, that's townhomes and duplex type homes. So condos are still outsell them all combined. So clearly there's still demand. Price point, of course, will be a big part of that reason. But just again, it's good to have that holistic perspective when the headlines are kind of really pushing one narrative. Let's look at what's truly happening. And that's a bit of information to share. Now, let's talk about pre-sale price versus resale price. Generally, and definitely in Vancouver, we expect to see pre-sale prices selling higher than resale ones, than used homes, for example. It makes sense, right? In today's market, they cost more to build, they're brand new, they're often sold obviously years ahead of completion. So pricing typically bakes in some of that future value. Important to note though, this wasn't always the case. I mean, 20, 25 odd years ago, pre-sales were actually sold for typically less than a resale home, as a lot of developments that were being built, this was largely for detached. I will share that developers had to incentivize buyers to go into these communities and buy these homes because, again, they had to live near construction. Maybe the landscaping wasn't done, roads were still being paved, etc. So they were actually selling for less. But of course, in Vancouver, after a couple of decades of pre-sales completing well above their original purchase price, sale prices, they inched up and have been at a premium for years. That is now changing, and definitely in the US. The US is kind of leading the charge here. Something we have not seen in 25 years. And again, I'm referencing America for now, but we know how the two countries somehow correlate. The relationship between pre-sale and resale prices has just flipped. Again, for the first time in 25 years, and there's a good chart that we're going to show that shows that. On a national average, resale homes are now priced higher than new builds, Of course, every local market is going to have its own nuances, but this is an inversion that is worth paying attention to. So why? How is this happening? There's a few reasons that come to mind. First, it signals weakness in the new home market, right? Builder sentiment is low right now, and many developers are having to sharpen their pencils, sharpen their prices just to move inventory. Second, it could be that builders are shifting focus to these smaller, more affordable products, which naturally brings down the median price. And lastly, this is where the US market, it does differ from Canada, the lock-in effect. Because of course, in the States, millions of homeowners have locked in ultra low mortgage rates during that COVID era. And they lock in, of course, at full amortization. They can get a 30-year mortgage. They can get a 25-year mortgage, which we cannot here. So if they, of course, were to sell today, they'd be trading a maybe 2 or 3% mortgage for something closer to 7%. So that's a massive loss in buying power. So unless they absolutely have to sell or whatnot, they typically aren't. And what happens, of course, is when an existing homeowner, when they stay put, well, the resale inventory dries up. That's exactly what we're seeing down there. Bit different in Canada, but we are seeing more and more pre-sale discounts, of course, and new projects are launching at subjectively more reasonable prices. So I think those two metrics are going to start to converge more and more in Canada as well, like we've now seen in the States.
You know, Dan, there used to be a time when buying new was cheaper, typically all the time, because you're competing against an established neighborhood versus one that is typically up and coming. And in order to get people into that up and coming neighborhood, you typically had to build product that was more affordable, that was more interesting for people to go to. And, it's been this phenomenon really in the last little while where we've constantly seen the prices and materials and labor that has shot up. And in Vancouver specifically, the development fees and things like that have made, building brand new so much more expensive. It's down to brass tacks, literally, which has caused that that disparity. I also think the other big part of this is when you look at the resale market, and if somebody's been, living in their home for 25 years and they've got 25 years of equity and potentially no mortgage to pay, well, then they don't have to drop their price compared to somebody who's paying $100,000 a month in interest on their project. So I think that there's reasons why we could continue to see this fall, and where the resale market might actually be a little bit more robust. We'll see. Looking now at a bit of a mortgage update here, the household debt service ratio increased to 14.4% last month, marking the first increase in 18 months. The amount of disposable income that's going towards interest payments remains near a 15-year high and will cap consumer spending, and it'll certainly weigh on economic growth. Despite high levels of household indebtedness, the BOC just reported that households continue to manage their debt loads fairly well. Well, bravo, Canada. I'm proud of you for that. Loan arrears improved in Q2 across all consumer and mortgage credit products, including installment loans, credit cards, car payments, mortgages, and HELOCs. This may be thanks to household net worth hitting a new all-time high. That's right, I didn't mince my words there. Canadian net worth rose 1.5% in Q2 to a whopping $18 trillion, backed largely by strong performance in public equities. I have a little thought process on that. I think capital is always chasing a return. And when you've got things like US equities that appear to be really overvalued, and nobody really wanting to get involved in Canadian real estate at the time being, where else is that money going to find itself? Well, hello TSX, and it's up about 24% year over year. On the other hand, consumer deposit growth continues to slow. This is important. This is now down 5 of the last 6 months, as people may very well be putting more money towards higher mortgage payments and the higher cost of living, as we are well into the renewal wall, which will see around 60% of mortgages renew this year and into 2026 at higher payments. So an important note to mention outside of all of this is that, unfortunately, consumer confidence in Canada still remains extremely low. It's basically flat month over month, sitting near record lows at 60. And for perspective here, at the pre-pandemic levels, the measure was 120. So we are half the level of consumer confidence than where we were just 5 years ago. So if you're curious about interest rates, as of today, markets are placing a 50% chance of a rate cut at the next meeting. That's October 29th. And that'll be the second last meeting of 2025. The odds will likely change prior to that, but based on everything we're talking about here, Dan, I think it's something that the Bank of Canada will be seriously considering, whether it's in October or in January. I think it's inevitable.
Okay, and here we are. Time for the October Greater Vancouver Real Estate Stats Update. The numbers just came in this morning. It's Thursday, October the 2nd, and we are reporting this to you as soon as it is possible. As always, we start off with the sales. How many units sold? How many homes sold? What is the quote health of the market? Well, last month we saw 1,869 homes sell, up just slightly from the year before, about 1.2% higher than September of 24, but it did dip. It is 4% lower sales, fewer sales than the previous month, being August. This is a trend where September sales have been lower than August for the last 4 years in a row. Prior to that, there was at least 3 years where the September sales were higher than August. So an interesting shift in the marketplace overall. Big picture here, sales are they're depressed. There's no doubt they've been depressed all year, and they remain about 20% below that 10-year average. There is basically no fall market is what we're predicting here now. We called it fairly early in spring this year that there's going to be no spring market. Markets being, of course, a jump in sales volumes and possibly prices. But right now, with an absolute, let's call it a dud or a very slow September, don't see much reason for a spike for sure. Right now, I will say that, for the last 3 years, October sales do end up higher than September. And, we might see it up slightly, but again, to a small degree.
Yes, likely agree with you, Dan. It's going to be a bit of a nothing burger this fall. As we look at new listings, after declining for 4 months, September listings spiked. Again, this is a bit of a common theme for seasonal sales. We're at 6,526 new listings. That is 6.2% higher year over year and 20.1% above the 10-year average.
So even with that jump, inventory, it actually lowered for the third month in a row. And the only 3 decreases for the whole year of 2025 so far. The month washed out with 16,302 listings, down just a hair, like 0.03% month over month, but up 7% from a year ago. Big picture again, really, really high levels of inventory comparatively, about 36% above that 10-year average. And of course, people relist on the first of the month, or people decide to come to the market first of the month. There's already 18,000 listings again. So there is a lot of competition, or a lot to choose from, depending which side you're on.
When we move over to sales to active ratio, we're looking overall sitting at 12%. That is borderline balanced buyer's marketplace. That is the same as it was last month. This is the 16th month in a row in a balanced marketplace. We are 9% for detached homes. That's exactly the same as it was last month. 14% for townhomes, which is the same as it was last month, and 14% for apartments, down 1%. That actually, Dan, that correlates exactly with what we were talking about earlier about how apartments still leading the charge in terms of overall sales compared to the detached market, which the consumer confidence levels for that are well within buyer market territory.
Now, here's where we are seeing a very notable change, and it is foreclosures. Foreclosures have jumped, the largest we've seen in a year. Combined between detached, attached, multifamily, and land sales, there were an additional 51 new foreclosures that hit the market. There are now 420 active foreclosures out there. And we've been reporting on this for exactly 1 year now. We started in October of last year. And at that time, there were 230. So year over year jump in foreclosures, up 82%. Okay, this is becoming notable, of course. 420. This is across, again, the entire lower mainland. So again, related to total active listings, it's incredibly small, but obviously an 82% jump is big and worth discussing. So again, we're going to keep an eye on this and track it every month for you. But hey, at that level, 420, are there quote unquote deals available in some of these? Possibly. If you're curious, you want to know foreclosures, what's out there, get a hold of us. We'd love to share the entire list with you to see if there's anything that sparks your interest.
And ideally, you want to do something about your property before you get into that position, too. Being in foreclosure is a very difficult thing for people. Moving on here now, days on market. We've increased for the 6th month in a row. This has only happened once before in history. And this is back in 2012. We are now 29 days on market. That is up 3 days since the last report. This is the highest days on market for September. And that was the last time we saw this was recorded during the global financial crisis in 2008, surpassing this by hitting 44 days on market. It's the only other time. So that should tell you a lot about the kind of economics we find ourselves in, and I think the likelihood of a future rate cut.
Okay, lastly is price, and we're going to start with HPI. And interestingly, sidebar, I got a call from the gentleman who created the HPI yesterday. That was a really fun call, and I appreciate you reaching out, Bill. That was really fun to learn more about you and your contributions to the real estate, and to learn more about your software. Maybe we'll throw a link in below, because he's created some really fun software that analyzes prices across Lower Mainland, and you can analyze your own property price almost apples to apples. It's really powerful. Anyway, on to price. HPI dropped for the 6th straight time in 2025. It dropped about $8,000 last month, or 0.7%. Prices are down almost $49,000, or 4.2%, since the 2025 high, if you call it that, which we experienced back in March. Year over year, HPI is down 3.2%. Average price for that home, looking at the HPI, $1,142,000. Now, as always, we look at the other price metrics to help share further insights there. Ian, down 20K last month to 935,000, with average going up 24K to $1,253,000. Home prices are back to about March of 2023 levels, but my goodness, when you kind of dive into specific areas, there are obviously more dramatic drops. I just shared some intel with a client for condos in Mount Pleasant East that are down to 2019 prices overall. So really important to understand how hyper-local these markets are if you're looking at buying or selling. Final words, as always. What do you think?
Listen, we talk a lot about being able to distinguish between the noise and the signals that a market is producing. We just went through a litany of signals to pay attention to. I cannot stress it enough. Understanding where you fall inside of a market cycle is the difference between making a success of your next purchase or a failure. This is sort of an opportunity, I think. When you look at the future supply of homes coming to Canada, you can see a future price crunch coming. And so when the writing's on the wall like this, you have to be potentially a little bit more greedy when others are fearful. And right now, we have clients who are getting great deals. And it largely is going to depend on what you think of Canada and your confidence in Canada. If you think this is a great place to live and grow a family, then I wouldn't be too concerned about the long term. I do think, however, in the short run, if we're going to improve our economy, it's going to come down to the backs of the people who live here, the people who work here. We have to turn this country around, and our government's not going to do it. They can't figure it out. So it's going to come down to business owners, people like ourselves, and people in the economy to make the changes that we need to see. We can't keep leaving it up to people, a small group of people who seem to think they have their hands on the dials when they keep turning them the wrong way. So in short, what's next? I think a rate cut. And then we, as a country, need to figure out how we're going to fix this mess.
There you have it. Thank you, as always, for tuning in, watching. Love to hear your comments. As always, we do our best to reply to each and every one. Have a wonderful week, and we will see you here next week. Bye.